Why are non-residents taxed differently than Canadian residents on rental income? If you're a non-resident renting out property in Canada, you may be surprised to learn that the rules are different than for Canadian residents. From how taxes are calculated to which forms you need to file, the CRA takes a very different approach depending on where you live. So why does this difference exist, and how does it affect what you pay, what you report, and what you're allowed to deduct? Let's break it down. It starts with where you live. Canada's tax system is based on both residency and source of income. Canadian residents are taxed on worldwide income, while non-residents are taxed only on Canadian source income, such as rent from a property located in Canada. But the way that income is taxed differs. Canadian residents' net income tax model. When a Canadian resident earns rental income, they file a standard T1 tax return and report net rental income, that is, income after subtracting allowable expenses. These may include mortgage interest, property taxes, insurance, repairs, management fees. They pay tax according to Canada's progressive tax brackets, just like unemployment income. Non-residents gross income withholding unless they elect otherwise. For non-residents, the default tax method is very different. The CRA requires 25% withholding on gross rental income under Part 3 of the Income Tax Act. This means tax is calculated before any deductions are considered. Even if the property is losing money, tax is withheld upfront, typically by the tenant or property manager. Unless the non-resident makes an election under Section 216, allowing them to file a return and be taxed on net income, just like a Canadian resident. This election isn't automatic. It requires filing specific forms like NR6 and later submitting a Section 216 tax return. Why the difference? There are a few reasons why the CRA treats non-residents differently. Enforcement risk. The CRA has limited reach outside of Canada. By requiring upfront withholding, they ensure tax is collected before income leaves the country. Administrative simplicity. Withholding tax is easier to enforce than chasing tax returns from thousands of non-resident property owners. Encouragement to comply. The CRA provides the Section 216 option as a benefit to those who follow the rules. If you elect properly, you're rewarded with tax treatment similar to that of residents. Equity and protection. The tax system is designed to ensure non-residents pay their fair share for earning income from Canadian soil using Canadian infrastructure and services. So what should you do? If you're a non-resident and simply let the default withholding happen, you may be overpaying tax unnecessarily. Filing under Section 216 allows you to reclaim what you don't owe and align your tax treatment more closely with what Canadian residents receive. If you require assistance with Canadian tax matters, our team is ready to provide reliable professional support. Please contact us at 416-283-8774 or visit theaccountingandtax.com for more information. And if you found this video helpful, don't forget to like, subscribe, and share.